Greetings, fellow traders. I'm Dilin, a research strategist at Pepperstone, presenting the latest weekly update on As Good As Gold. So in 2024, we've seen gold prices kind of wobble downwards. They've dropped from their high of 2088 at the end of last December to around 2030 now. This dip can be chalked up to a few things like better than expected economic data, the market rethinking how much the Fed will cut interest rates, and the usual ups and downs of the dollar asset. With a bunch of risk events lined up this week, traders are keeping an eye out for more economic data to figure out their next move with gold. So if you look at the daily chart of gold against US dollar, gold's been on a bit of slide since the year kicked off. It tried and failed to break past 2088 on January the 2nd, and by last Wednesday, it even dipped below the $20.48, a key level from April and May last year. Despite a bit of tussle between buyers and sellers later in the week, the price didn't really bounce back. Right now, gold's hovering around $20.30, and $20.16 might be its next cushion. That's not only this week's low, but also close to the 23.8% Fibonacci retracement level from the uptrend we saw from last October to December. And if sellers keep pushing hard, we might see some buyers jumping around 2009, which was the peak point last quarter, before gold dips below the big $2,000 mark. On the flip side, if gold's going to climb back up, keep an eye on the 20-day moving average and the 2048 resistance level. Now, why is gold under pressure? I think a big reason is how the market is rethinking the Fed's plan for interest rate cuts. The US has been churning out some pretty good economic numbers lately. The job market is heating up, fewer people are filing for unemployment, and the ADP employment numbers are looking up. Plus, the December jobs report blew past expectations, and wages are climbing. This kind of strong job market vibe is making people doubt whether the Fed will start cutting rates in March. Also, there's been some talk from the Fed that makes it seem like they might slow down on rate cuts. Last week's FOMC minutes hinted at keeping rates higher for longer and the fact that easy money could be a problem. This talk pushed up US Treasury yields with 2-year yields around 4.37% and 10-year yields back over 4%. With the support of interest rates and the poor performance of US stocks, increasing the demand for hedging, and the US dollar has shown upward momentum. Meanwhile, the real rates in the US are near 1.8%, and the software is now thinking the Fed will cut rates by 145 basis points next year, down from 160. In simpler terms, it's getting more expensive to hold on to gold, so no surprise prices are dropping. Even though the swap market is only seeing a 70% chance of a 25 basis point cut by the Fed in March, I think there's still room for gold to go up in the medium to long run. First off, even though the jobs are up, the total 2.7 million new jobs last year was way less than the number of 4.8 million in 2022, showing that labor and overall economic demand are cooling down. Also, the US December service PMI hit a new low since last May, and the employment part of it dropped to the lowest since July 2020. This shows that while the job market is tight, not all industries are doing great, and it doesn't really change the expectations that the US interest rate will get trimmed this year, just maybe not as soon as we thought. With the rate cuts on the horizon, gold could rise this year. Also, uncertainty in global conflicts could push gold prices up. We've got the US and UK elections starting, and they will wrap up by the year end. Plus, 2024 is a big election year worldwide, so a lot of political shifts could happen, impacting global relations, the Russia-Ukraine situation, and other geopolitical issues. So this kind of uncertainties makes gold an attractive option for traders looking to hedge against risk. In short, right now, sellers are kind of in control of the gold market, mainly because everyone's rethinking how the Fed will handle rate cuts. But looking ahead, a cooler job market and political uncertainties could give gold prices a boost. For the rest of the week, keep an eye on the US December CPI data. The market is expecting a general or the headline CPI month-over-month increase of 0.2% and year-over-year increase of 3.2%, while the core CPI going up by 0.3% month-over-month and 3.8% yearly. If inflation numbers are higher than expected, it could further lower expectations for a US rate cut in March, potentially pushing gold prices up. So that's all for this week. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!